I'm here today not to talk about the past, I've done that, not to talk about the present, my colleagues are doing that, but I'm here to talk about the future of private equity and the future of Terra Firma. If I look at the future, I think there's two things to focus on. One is the private equity industry as a whole, and the other is obviously Terra Firma, and how does it fit into that? How do we take the last 13 years of partnership relationships, over 190 worldwide, and how do we bring that to another level and develop it in the future? And a lot of you have been very generous with your time over the last year. Over the last year, I've pretty well met every single investor we have, every single LP, every single partner. And specifically, over the last 3 or 4 months, I've gone back and raised some ideas and had an interchange of thoughts, processes, fears, dreams, ambitions, with about 50 investors in Europe, North America, the Middle East, and Asia. And I think today is a good opportunity to talk about what I heard, what I learnt, and to feed it back. Now, firstly, there were 4 very, very consistent points, very important points, that pretty well came up in every one of those 50 meetings. Number 1, investors want alpha from their private equity investors. And that might sound like a statement of the obvious, but the reality is over the last few years, the alpha delivered by private equity has reduced. And investors have seen that. It's done very well because since 2009, the markets have done very well. But the actual alpha provided by private equity has reduced substantially. As a number of investors, sophisticated investors, said to me, the private equity industry is really providing us with leverage beta, and expensive leverage beta of that. And some, a handful, went further and said we can create effectively something that tracks what private equity does, but at a vastly less cost for a handful of basis points. And some went even further and said if the private equity industry doesn't change, they're going to get disintermediated the same way as a lot of other asset managers have in a lot of other businesses. Secondly, and I suppose it's not surprising, following on from this, pretty well all the investors I saw, all our partners, said they wanted lower fees. They believed that the fees were too high, particularly in 2 areas. Uninvested capital, which they pointed out that the current amount of money available will last about 10 years. So on average, they'll be paying 7.5% before anything's invested. And on large funds, where they feel the amount earned is so enormous now that really the carries become pretty irrelevant and the institutions are just managing for fees. Now, when we formed Terra Firma back in 2002, we looked at the relationship between LPs and GPs and how GPs got paid, how LPs paid GPs. And we became the first private equity firm to agree not to charge any monitoring, any board, or any transaction fees, and further, to refund, this is back in 2002, to refund 100% of any fees we earned. And that was pretty unusual at that time. Today, it's not quite universal out there, but it's almost universal. Well, I'm going to announce another first. Going forward, and I hope this becomes the norm in the industry, going forward, we will not charge any fees on uninvested capital. We will only charge fees on invested capital. The next thing that investors said to me was that they wanted fewer relationships, but they wanted closer relationships. Now, I said I'd be blunt and honest. It's a two-way thing. I can well understand LPs not wanting to have so many relationships so they can get a better understanding of what the GP is doing. But the reality is that for GPs to give a proper service to LPs, GPs as well need to have fewer relationships. You can't actually have a really close relationship with 190 LPs. So, and this would be, I'm sure, is a strange thing for a GP to say, but we actually want to have less relationships, but we want to have much deeper relationships. We want to have relationships where we can co-invest together, where we can discuss what's going on in the market. I'm not saying going back quite to the relationship we had when we had Nomura backing us, where you could literally walk upstairs and shoot the breeze, discuss a deal. But I am saying going back to the sort of relationship where you can get on the phone and you can go around the majority of your investors in 2.5 hours and say, what do you think about this? The final point of the four was that, and I think in some ways it's the most important point, and I say that because of what we've seen in all our businesses. LPs wanted GPs to have skin in the game. They wanted a real economic alignment of interest. Because as some of them said, they saw this as the biggest indicator of future performance. The reality is all the surveys out there have done, the past is no indication of the future in private equity. There's absolutely no correlation at all. But whether people have skin in the game or not is a pretty big indicator. In Terra Firma, we can draw you a graph of the performance of our deals versus the skin in the game the CEOs of those firms have. And it's totally related. It's got a hugely positive correlation. Bizarrely, the other thing is the lower the salary we pay them, the higher correlation as well. So if we want to actually get a good performance out of our business, the answer is pay our CEOs as little as they'll possibly work for in cash and give them a big bonus. That's common logical sense. It's what the industry was brought up in the 1970s and 1980s. Why would human nature have changed over the last 30 years? So, in the same way as we're not going to charge fees on uncommitted capital going forward, we're similarly not going to sponsor any deal, anything, unless we can put at least 10% of our own money into it. Because we think that's important. Now, based on the overall feedback there from you, our partners, I strongly believe that there's a need to recreate the alignment between GPs and LPs. I believe that that alignment needs to be recreated in order to be in a position to recreate alpha together. The industry needs to go back to the future. Now, going back to the future also chimes very well with some of the mega trends that are affecting the industry at the moment. And let me highlight a few of them, and you'll probably understand why the fund of fund firm didn't want me to continue to come to their conferences. First, GPs out there are sitting on a record pile of dry powder, while new deals are at a 13-year low. There's more than $1 trillion of dollars of uninvested dry powder out there. And that's excluding roughly the same amount that's been set aside by sovereign wealth funds, etc., to direct directly or through co-investment vehicles. LPs aren't excited about paying $15 billion a year in fees with a less than 1 in 10 chance that the money gets invested each year. Not surprisingly, in the face of that, the larger LPs are increasingly putting more money into specialist separate accounts, co-investments, joint ventures, and directs. As I said, by some estimates, only half the money now going into private equity investments is going in from funds. The rest is going in directly. Now, a reason, of course, that the dry powder out there is so high is because valuations are also high. And there's a severe shortage of deals on the table. The other side of that coin is that the market for exits is very good, and exits are at a record high. Even the ABS market is finally, after 8 years, coming back. Meanwhile, because investors tend to look at the past, and because investors are getting huge amounts of capital back, the big firms are getting bigger and bigger. The big global private equity firms have become brand name asset managers. They've become household names. But the amount of skin directly applied to funds is falling. A fair number of funds now put in less than 1%. And that less than 1% is really not connected with the employees who are managing the money. Sometimes you've got hundreds of employees, and sometimes you've got literally thousands. And those employees, and I interview a lot of them, have little real connection to their investments, to the firm, or their investors. They are effectively become very like where they came from, investment bankers or consultants. Meanwhile, the smaller firms, the ones who are still entrepreneurial, the ones who still do have a big connection, are finding it difficult to survive. Many of them, 140 in Europe alone, have not raised new funds since the credit crisis. Now, in talking to investors out there, I came up with a message for Terra Firma, for ourselves, for myself, but also for those firms. And that is, if you're going to survive in this new private equity world, you're going to have to do something different to the big guys. The investors I met had absolutely no interest in smaller firms just doing the same thing. They wanted them to do something different or something the big guys wouldn't do. But they also said that a lot of the smaller firms they see are really just smaller Me Too versions of the big firms. Now, away from that, investors continue to express confidence in the industry. But if you look at the overall returns since the crisis, and since the crisis should have been a very, very good time for private equity, particularly in the States, where the bailout of the banks really did help and get transferred across to refinancings and revaluations. But if you look at those returns, most funds haven't outperformed the public markets, even with the additional leverage they have. And the US endowments, the original sponsors of the private equity industry, nearly 40 years ago, the Harvards, the Princetons, the organizations which really do know this industry through its history, through its ups, through its downs, they have recently started to cut back. Their estimate is they're going to cut back their allocation to private equity by 20% over the next year. So unless and until the private equity industry can start to add alpha again, there's going to be a question mark hanging over the whole industry in terms of, are LPs really getting value for money at these fee levels?